let's jump right into an example. So let's compute the weighted average cost of capital for Zero motorcycles. So let's say Zero just reported a balance sheet and an income statement, which I'll get to in a minute. But let's look at the balance sheet. So these are in millions. So they have 50 million in current assets. They have net PP of 100 million, total assets 150. They have short-term debt of 25 million, other current liabilities, long-term debt of 50 million. And we get down here to their equity, which is their total assets minus their total liabilities. 150 minus 125 is 25 in most circles, so Yahoo for that. And let's see what these notes say here. So debt balances have been constant for the past year. Okay, so that's great. That means in the most recently reported balance sheet, it was 25, but also the year prior balance sheet, it was also equal to 25. And same thing for the 50 down here. So that's good to know. Otherwise, we would need balance sheet from last year, and you'll see why in a second. Okay, what's our second note here? Equity market value is equal to equity gap. Okay, that's good. And this does happen, not with some infrequency, that the gap value of equity happens to be pretty close to the market value of equity. So that's good. So we can just use this for our market value of equity. And while we're down here with the notes, let's see what this says. The firm estimates its RE at 20%. We know from the last chapter how they did that, right? They probably used CAPM and got their beta, estimated their market rate, all that jazz, and did what we did in the last chapter to estimate their RE. Okay, so now let's go ahead and look at their income statement. So in the past year, they had 50 million in revenue, COGS and SGA of 20 million, interest of 10, tax at 5, and net income of 15. Okay, good. So this is what we know about Zero motorcycles. And what are we asked to find? The company's weighted average cost of capital. Okay, so we only have one equation for that. Weighted average cost of capital is going to come from this equation. So we just need to make sure we have everything to plug into this equation and then just plug it in. Okay, so for the pre-tax cost of debt financing, that's going to be what? The interest divided by the total debt BOP. That's the way, if we're getting our cost of debt financing from financial statements, this is always the way we get our pre-tax cost of debt financing. So what's that equal to? I have no idea, but let's go back and find out. So the interest was 10, okay, and the total debt, short-term debt, long-term debt, has nothing to do with short-term, long-term. We want all the debt, right? Because they're paying, this interest payment came from all of it. Didn't matter if it were short-term or long-term. So 25 plus 50, that's 75 in most circles. So we have 10 divided by 75, and that's equal to, I think, 0.133. But let's go ahead and check that here. Yep. Okay, so that's 0.133. Okay, so our tax rate is our income tax rate, and that is always our tax divided by our EBT. Okay, and let's see what we had here. Our tax was 5. Okay, our EBT is equal to 15 plus 5 or 20, right? Because that's earnings including everything except for tax. So with tax, I got 15. If we back out the tax, it's going to be 20. So we have 5 over 20, and I can even do that one in my head. That's 0.25, right? Because 5 times 4 is 20. Okay. And our cost of equity financing, that was given. They probably got that from CAPM or something like that. And the weight of their debt financing. So that's going to be D over D plus E. Okay, and that's going to equal the total debt there is 75 divided by 75 plus what's their equity? Their equity is 25, and happily it says the market value is similar to the gap value. So we'll go ahead and use that. 25. So 75 over 100 is equal to, there's another one I can do in my head, is equal to 0.75. So that's looking good. Okay, so the weight of equity financing is E over D plus E, and that's 25 over 75 plus 25, and that's equal to 0.25. Okay, so let's just do a little check here. Is 0.25 plus 0.75 equal to 1? Yes, okay. Good for us. All right, so that checks. So now we can just plug in. We've got everything we need to plug in for the weighted average cost of capital. So this is going to be 1 minus the 0.25 is their tax rate times what's their pre-tax cost of debt, 0.133, and now we have to multiply that by the weight of their debt financing. So that's going to be times 0.75. And now we have plus their cost of equity capital. They estimate at 20%, 0.2 times the weight of equity for them is 0.25. And let's just plug that into Excel and see what we get here. Okay, I got 0.125 or 12.5%. Okay, so that's it. That's how we compute the weighted average cost of capital for a company. So no big deal, pretty straightforward. And this is what we would use to discount with if we're trying to get an NPV for all stakeholders, for debt holders and shareholders. So now let's sort of summarize a little bit, because we've gone through a lot of stuff here. So let's summarize our quantities for the NPV methods for valuing entities for owners and stakeholders. So first of all we're going to do, and this is going to be true for the rest of the term, happily, we're going to use our simple accounting cases where depreciation is our only non-cash expense, et cetera, et cetera. Okay, so in that case, when we're trying to get an NPV for shareholders, this is the equation, again, that you need to know. Free cash flow to owners in year I is going to be net income in that year, plus depreciation in that year, minus changes to working capital in that year, minus capital expenditures in that year, plus any changes to the debt in that year. And again, these are what we call the levered cash flows. They're levered because they come after we pay interest. They represent and include the effect of that leverage of having to pay that interest, okay? And the discount rate that we're going to use in our NPV equation is just going to be our RE, cost of equity capital, as we've learned to compute from CAPM, or we could estimate from the opportunity investment model, or et cetera. And again, CAPM is really equity-focused way to get RE. Opportunity investment model is really good for things like bonds, anywhere where you have a contract, and it's honestly not as good for something like equity where there's no contract and it's just very hard to find an opportunity investment that's a diversified portfolio of stuff, et cetera, et cetera. Okay, so now how about finding NPV for all our stakeholders? So again, I'm just summarizing what we've done so far. So our free cash flow is going to look very much like the formula up above, except we exchange net income for NOPAT, and NOPAT is equal to EBIT minus tax. And we've removed the change in debt term as we're getting cash flows to debt holders and equity holders both. Other than that, it's exactly the formula that we had up here, so not too much extra to remember. These are the unlevered cash flows because these are the cash flows before we take into account that leverage, having to pay the interest on the debt. And in this case, the cost of capital that we want to use, the discount rate that we want to use, is our weighted average cost of capital, which comes from the equation we just beat to death. So going forward for the rest of the term, we're going to focus on NPV to owners unless otherwise stated. So we're not going to be so concerned with finding NPV to all stakeholders. We're going to be focused more on NPV to owners. Okay, and I bet you thought you were not going to see my ugly mug anymore in this lecture, but you would be so wrong. I suggest that you go away, hang out with your friends, chat, play video games, read a little bit from your favorite finance textbook, and come back a little later